This is where we have to give these new technologies the room to commercialize. And I worry a little bit about that in the current market with advanced geothermal and advanced nuclear, particularly the advanced nuclear companies that have gone public, have really high valuations and have not yet built a project, that there will be sort of this point in 2 years where, oh, you don't have 10 gigawatts of power installed, you're a failure.
Yeah.
And I don't think that's the right conclusion. I mean, we have to look at solar and wind and energy storage, and it took those industries 10 to 20 years to really get to where we are today, where they are leading the world's power generation.
My guest today has lived both sides of the story. Inside the DOE's Loan Programs Office, overseeing billions in project finance, and now as co-founder of Aligned Climate Capital, deploying capital into the real backbone of decarbonization. Brendan Bell, COO and Managing Director of Aligned Climate Capital, and as I said, former DOE Loan Programs Office leader, early utility scale solar steward, and today, one of the most disciplined voices in how capital is actually flowing into the energy transition, is here to help shepherd the discussion. Brendan, good to see you, my friend. Welcome.
Thank you. It's exciting to be here.
Yeah, man. As I mentioned, a lot of folks, I'm sure, when they look at your LinkedIn, they immediately land on working at DOE, helping with Loan Programs Office, et cetera. And you helped steady the DOE LPO during, let's call it a high-stakes chapter. When someone asks what you actually did there, how do you explain it?
We were just trying to get this program back up on its feet. This was, in our view, an amazing program that was helping the United States deploy new technology, but it had made a loan to a company called Solyndra, which went bankrupt in a very, very public way. And so my partner, Peter, and I were brought in after that bankruptcy to get the program back up and running, implement some changes and some improvements that, were there to help make sure that, we were spending billions of dollars in a way that would help taxpayers.
Is there a project or moment that really captures the stakes for that time for you?
It's funny to think back on it, right? It wasn't that long ago. I guess it's getting longer ago now as we go. But, at that point, the thing that sticks with me, right, is two things. One, we made a loan to Tesla, and we also made a loan to Fisker. And I think if you had asked any of us at the time which company was going to do better, it would be Fisker.
That's right. I
we
remember.
Were wrong, right?
We were both wrong.
They had more experience. They had a more advanced product, all those sorts of things. And that obviously turned out not to be the case. The same was true. We had 10 utility scale solar projects that we financed at DOE. And again, just we were debt for these projects. The sponsors were companies like Nextera and AES and others, very established companies that had equity. But at the time, they couldn't get debt because these were new technologies, new projects. We were post the financial crisis. So we did 10 projects, half of which were PV solar and half of which were concentrating solar.
Oh.
And at the time, we didn't know which technology or both were going to succeed or win. Right. And, now looking back, the results are clear, right? PV solar is the winner. No offense to anybody out there working in concentrating solar, but they've had different trajectories.
They've been offended in other ways. It's okay.
Exactly. So I think that's the kind of the thing that I remember the most of that time was just we were still waiting to find out which technologies were going to be the winners. Yeah. There was not institutional capital at that point. BlackRock didn't launch its first global renewable power fund until 2017 or 2018.
Yeah.
So this was a different time. And it's amazing to watch what has happened in the industry since then. And I think that's something we should all reflect on, particularly in these times when it feels like things are going badly or there's a lot of, negative pressure on the industry. We've accomplished a lot in less than 20 years.
Totally.
And that's something we should feel good about.
To that end, I think they're great examples. You came in on the heels of Solyndra needing to, in some ways, sort of save face for climate, clean tech, whatever it is that we were going to eventually call it, rebranding that adventure. How did that experience shape or maybe reshape your sense of downside protection?
Yeah, it's certainly, my first experiences working in this industry were at DOE in the loan program office, and we had 5 distressed assets, Solyndra being one of them, Fisker being another, that we had to do workouts on. So, we as a portfolio made money for the taxpayer. We launched some amazing industries, but we also lost money.
Yeah.
So I think when you issue loans and when you deal with, innovative technologies, you get very acute about thinking about what could go wrong. because everything went wrong.
Yeah.
Even our successful loans, the projects got delayed, the technology didn't work, the EPC firm went bankrupt, and we had to recast that. So I think you have a view of what can and will go wrong in projects, and that you can still make successful investments even with things not going exactly to plan.
I wonder if you have a sense, just reflecting on sort of now versus then, was there anything that was particularly maybe broken in the way that Washington and Wall Street thought about clean energy, or how have you seen that evolve as the infrastructure and asset class itself began to mature?
It's interesting. I think at that time, I think those hubs, Wall Street, Washington, the government, capital allocators, and also sort of technology, people who are developing technology, whether in the Bay Area or others, they really weren't talking to each other. And so part of our just basic goal was to bring those parties together. And I think today you look at it, and it is a product of our success. I mean, those pairings have really created something very powerful in our country and around the world. And I think today there is more conversation. I think there is more awareness from policymakers about how capital markets work for clean energy. That doesn't mean they always make what we think are the best decisions, but they understand it and they understand the implications of what they're doing. Yeah. It was so nascent at that point that I think we've come a long way.
I'm curious about the inflection points where the narrative changed from sort of possibility to performance, and maybe kind of where we're at now in the dialogue. You've spent a lot of time helping institutions, pensions, endowments invest directly into climate. Can you talk me through what those conversations are like and how they've evolved over the last 8 to 10 years?
I would say that in my mind, there were sort of 2 points that have stood out as terms of, oh, wow, something's changed here. There was kind of 2017, 2018. So when I left the Department of Energy, what we were first doing is we were helping 12 institutional investors, large pension funds, sovereign wealth funds, endowments, invest again in clean energy. They had all made investments in the 2000s and kind of the first clean tech boom. It hadn't gone great for them, but they were starting to see the energy transition come back. They were interested in exploring it, and so we helped them find investments. And that was around the time that the first institutional global renewable power funds were being launched. And so real institutional capital was coming into this market at scale. The projects were backed by investment grade technology manufacturers. They were able to access capital in a way that they hadn't in the prior few years. Utilities and corporates were signing long-term PPAs for these assets. And so that was definitely, money was starting to flow in, money that was not necessarily climate oriented or impact oriented. It was just here to make money in infrastructure. That felt different. And that was a noticeable change. And then I think there was a period in the 2019, 2020, 2021, when every day you'd come into the office and the new PPA for solar or wind would come up and it's the lower price than we've ever seen before.
Yeah.
Right. It was just clean energy got cheaper than anything else. And that was the moment that everything took off. And I think, to me, people look back at sort of, oh, there was this awareness around climate change, and that was very important, and I think brought a lot of people into the sector, but it got cheaper. And that was where things just switched. There was a period where Indiana Public Service, right, which is one of the biggest utilities in the state of Indiana, not motivated by climate, not forced to do this because of policy, they announced that they were closing a bunch of coal plants and replacing it with wind and solar. That's the proof point, right? And so I think that is where I think we've seen the biggest changes. That, when we were at the Department of Energy, the projects that we were backing were selling their power for 2 to 3 times what, a natural gas plant was selling it for. And we were just having to convince these utilities they had renewable energy standards to meet. They had other reasons to do this, but it wasn't the cheapest form of power.
Yeah.
We cleared that hurdle a couple of years ago, and it's, the growth has been remarkable.
I know that you don't think of the investment class as clean tech, and I would say that climate tech is on its way out the door in terms of like the way we want to talk about it. When did it click for you that this wasn't really like a clean tech channel? It was the next evolution of energy. You mentioned watching this precipitous fall of a new category of energy, clean energy, being able to basically outprice the incumbents. I'm wondering if there was a specific data point or project or something else that shifted your worldview and the way you think about and even communicate to potential investors this asset class?
It's probably because I come out of energy, right? I don't come from a venture or tech background originally.
Okay.
So maybe it's just how I see it.
Yeah.
But at the end of the day, to solve climate change, we have to overhaul the world's energy systems, its transportation systems, the built environment. And obviously, all those things, technology is an incredibly important part of changing that, right? Whether that is energy production technology, whether that's batteries, whether that's vehicles, whether that's energy efficiency, whether that's software controls. But at the end of the day, it's more than just a software tool that you can get a business or a consumer to adopt. It's you've got to change things in the real world and in the physical world. So I think, and maybe it was being in that Department of Energy where our office was down the hall from guys with machine guns because they're guarding the nuclear weapons, arsenal. It just feels different, right? It doesn't feel like you're in a San Francisco Bay Area startup, right? So I think that's how we've always viewed it, is that the technology innovation will flow through infrastructure. And it will look probably a lot more like traditional oil and gas in terms of capital formation, market segments, having some super majors around the world that are well capitalized public companies, and then having midstream, having smaller upstarts. Because if you look at oil and gas, right? I mean, fracking was an innovation, right?
Yeah.
You can have technological innovation in large capital intensive industries, and I think that's how we see our sector more than maybe the analogies to call it B2B SaaS.
I think that you guys have been able to, from the perspective and even the perch of your prior sort of portfolio management and access to seeing kind of where the market was moving, have some prescient, from a venture perspective, investments, like bet on some winners. I would say notably Summit Energy, Summit Ridge, which I think is probably one of the best developers in the market. Swell, ChargeNet, the list does continue to evolve in terms of how you're placing bets in the market. Once again, for those who are unfamiliar with Aligned Climate as the vehicle through which you place these bets, paint a picture for me why it makes sense for you and your partner to dedicate time at this point in your career to this versus something else, and kind of how you maybe. It's the Christmas party answer. Like, how do you explain what you do to someone who has no context in like under 2 minutes?
Yeah, I mean, we're taking capital from large institutional investors and we're investing it in the companies and the assets that are solving climate change and creating clean energy. And I think from our perspective and our experience, the companies that we gravitate towards on the venture side are companies that are sort of developing these assets, creating service models for these assets. How do we do this stuff better, faster, cheaper? And that doesn't mean, look, I have a ton of respect for venture investors that are doing new battery chemistry or advanced reactors, or I am not the person you want to pick whose battery chemistry is better. And those are more traditional science-based, technological innovation-based backgrounds. And I think our view, and maybe this goes back to that experience with concentrating solar versus PV solar. Concentrating solar probably makes more sense from like a technology standpoint, right?
Yeah.
You're getting baseload power. You can integrate storage more easily. It just takes the actual process of building those projects takes longer. It's more complicated. There is something that's really easy about PV solar, which is you're basically putting a field of flat screen TVs down on some racking.
Totally.
Put up a fence around it and you walk away. And there's a simplicity helps.
I 100% agree. I was commenting on a post that Stephen Lacey made today about Fervo Energy because they've recently done, and they had an incredible successful round, right? They've been building this technology, in many ways, geothermal, like SMR is the technology that has always so much promise and can never scale or attract the capital to make it possible. It's the most tangible vector for anyone in oil and gas to apply their knowledge and scale and innovation. Yet the exploration cost is like a trillion-fold for geothermal compared to solar. And I'm asking myself this question out loud and on social media, bantering with Stephen, like, yeah, but like, I agree. I think Fervo is possibly the best, like, innovative company to come along in a long time for clean energy writ large. But is the juice worth the squeeze? Are we going to invest $1 trillion to get like a few Fervo-style geothermal wells that give us baseload power and feel like nuclear plants, because they practically are. They're burning they're like tapping into the Earth's magma. Or can we just run faster by like covering the ground with solar and betting on the efficiency of that market?
I mean, look, if we all had a crystal ball, we'd all be perfect investors, right? And we're big believers in advanced geothermal. We have an investment in a company called XGS, which we think is also a very exciting company in the space. But you're right. I mean, I think this is where we have to give these new technologies the room to commercialize. And I worry a little bit about that in the current market with advanced geothermal and advanced nuclear, particularly the advanced nuclear companies that have gone public, have really high valuations and have not yet built a project. That there will be sort of this point in 2 years where, oh, you don't have 10 gigawatts power installed, you're a failure.
Yeah.
And I don't think that's the right conclusion. I mean, we have to look at solar and wind and energy storage, and it took those industries 10 to 20 years to really get to where we are today, where they are leading the world's power generation. And we need diversification, right? It can't all be one technology. There's supply chain constraints with that. There are, grid management issues with that. So I think that's what I worry about is that, it's sort of, hey, I thought this was going to be $1 trillion company in 3 years and it wasn't. And so I'm out.
And if we're honest with that season of the market, like that's why Solyndra failed, not for lack of even market acceptance. Like I'm good friends with Mike Grunow, who was the head of marketing and at Solyndra at the time. He hired me into Trina shortly after that. Solyndra was kicking our butts in the development cycle for C&I. They were winning contracts left, right, and center. But the investment thesis was, well, they haven't made money for us yet, so we're out. And there was a capital call, and they went bankrupt. And I would wager that, to your point, companies like Fervo and SMR companies, like they're on this sort of ticking time bomb train where they've been under the radar, and they're no longer under the radar. They're like, it's like I kind of look at it and I'm like, well, you kind of have to eat crow here as the folks who said like, well, solar should be off the gravy train and all these other companies should be on the gravy train. Well, turnabout's fair play. It's going to come back home to roost. We've lived through this climate tech boom for sure. And I feel like we've gone through this hard valuation reset in the marketplace. And I'm curious how you, in a few sentences, might describe the season that we're in now from the perspective of founders, developers, and investors.
I think from investors, we're in a buyer's market. It's a good time to be an investor in the space. The fundamentals are better than any time I've ever been in this, right? We're leading around the world. There's huge installation. There's capital availability. I think for founders, it's still really hard. It takes a long time to raise rounds. People are very skeptical. I think particularly for later stage rounds, anything post Series B, that was where in the kind of the boom days, there were generalist private equity investors coming into the market, interested in taking positions here. There were corporates, there were banks. They've all pulled back. And so doing $100 million round these days is harder for sure. But I think it's forced people to be disciplined, right? People are not just looking at revenue, they're looking at EBITDA, they're looking at their burn rate. And I think that was a discipline that needed to come into this industry and this market. So I think we're probably in a time of realism, maybe, right? A couple of years ago, a team in a dream working in, electric vehicles or something could launch company and try to command a $200-300 million valuation. That seems reasonable compared to the AI boom that we're looking at right now. But it was sort of that same energy, right? Is like there's a race to get the right companies in here, and we're just going to flood the industry with money and see who wins. And maybe that works in tech. I'm not sure it works in our industry because it's not just like you turn around 2 months later and you have 1 million users. You need to build something. You got to put it in the ground. You got to get through permitting, and you got to get it actually built and working the way that your contracts require it to. So I think it's a different cycle. So I think, look, we are very bullish on this market. We're continuing to raise funds in this market. We're continuing to invest. We see a lot of great founders. I think that's the other thing that is new, or maybe not new, but more pronounced.
Yeah.
There are a ton of people who've now worked in these industries for 10 to 20 years.
Yeah.
They have a ton of experience.
How do you distinguish as a capital allocator betting on platforms like Summit Ridge versus technologies like the geothermal XGS. I'm curious what those conversations sound like internally for you guys on where the best leverage is in terms of making an impact in the market.
It's a really hard balance. I think there's probably, with backing new technologies, the potential is much greater. I mean, you look at, Nextracker's now Nextpower, right? I was about to say Nextracker, right? You look at some of those companies and the early venture investments are fantastic returns because, you're creating a company that has a product that a lot of people need.
Yeah.
There probably is a ceiling on development companies, right? I don't think we're going to see a lot of multi-billion-dollar development companies. You really need to have a scale of say, Nextera and Invenergy to command that, and it requires a lot of capital to get there.
Yeah, both of which are utilities.
Yeah, both of which are utilities, exactly. So you basically become a utility. But I think our view has always been, and again, it's maybe getting away from some of the traditional Silicon Valley mindset, is we're not hunting unicorns in our venture fund. If we can come into a company when its valuation is $30 to $40 million and we can sell that company in a few years at a $400 million valuation, that is a huge win for our investors.
Yeah. Say that again.
It matters. Your exit is based upon, how much of the company you own, where you came in at, and where you exit at. It's not based upon, you can have a lot of companies where they have a great valuation, but they've raised so much capital from the time you invested that you're so diluted that you didn't do that well.
You've called the investment strategy for Aligned bipolar in some ways. You've got the venture focus and an infrastructure strategy. What's the simple way you explain it?
Yeah, I think for us, we see it as investing in the kind of two different perspectives on the same market, right? I think for us, where we feel like we have expertise and where we watch is this broader global clean energy transition. And that relates to climate, it relates to energy security, it relates to the fact that the world is power hungry and needs more power. And so our venture business is investing in early stage companies that are bringing new business models. They are filling a market need. I mean, this is an energy transition where, there's still a lot of unmet market segments. There's a lot of room for business model innovation. It's sort of like saying fintech, right? Fintech is not stopping just because, there have been products successful for large banks. It's like there's a lot of different parts of that industry that you can tap. So our venture business is sort of looking at that earlier stage, backing companies, backing good management teams, backing good ideas. Yeah. Our infrastructure strategy is owning these assets, right? It's like real estate, right? And it's how I tell people, instead of owning office buildings, we own solar plants. But the nice thing is, we know who's going to pay us for 20 years and it's much easier to operate.
And is that, that's almost, it's essentially an IPP structure.
Exactly. Yeah. We acquire projects from developers when they're at notice to proceed. We finance them, we own and operate them, and we hold them as a portfolio.
What's that portfolio strategy on the IPP side for developers who are listening thinking, oh, I didn't actually realize that the infrastructure side of Aligned was a potential off-taker or potential acquirer?
Yeah, we work with a ton of developers. We're primarily looking at kind of that middle market of solar and storage, 1 to 20 megawatts. It can be community solar, it can be PPAs, it can be tariffs. But
rooftop we work all ground mount stuff.
Ground mount, rooftop. We haven't done one yet, but I'd love to do a floating solar project. I think I love that technology. Nice. So yeah, we're very flexible. For us, it is, we don't do merchant projects, but and we're kind of in that middle market size, but we work with developers. They bring it to notice to proceed. So fully developed interconnection agreements in place, all the permitting. We then buy the project from the developer for a development fee. And then we oversee and finance construction, place the debt, sell the tax credits, and then own and operate the projects.
So you buy it at NTP, and then you basically buy the contracts included in the package that ensure getting it through COD.
Yeah. A developer will usually create an LLC that's the project company, Sandy Road Solar LLC 1. We've got a lot of those in our portfolio kind of thing. And then that LLC owns the offtake agreement, the interconnection agreement, all the permits. It's all held in the project company, and then we buy that project company from the developer.
Right. But presumably that project company already has like EPC and procurement contracts in place for that project. Like everything's buttoned up, or do you guys take on some of that risk?
We generally are picking the EPC. But sometimes it depends on the developer. Some developers have different capabilities. Some want to control that process. Others would rather have us do it.
I didn't realize that. So you have some internal dev capacity on the team that, or rather, construction capacity, folks that understand how to build the projects.
Yeah, we have a construction team.
As many conversations I've had with you, Brendan, I'm learning on this conversation more about the structure of your business than I understood.
I think it helps us. For instance, the head of our construction for our solar business just went and saw a new racking technology that's one of our developers is utilizing for our project. And that company is raising a round. And I think we're really interested in it.
Oh, fantastic.
Because our construction team liked it, right? Yeah. And I won't say who it is, right? But I think to me, that is the benefit and that's the genius of our bipolarism, right?
Yeah.
Is that I think unlike other venture investors, we actually have a construction team that goes out and sees the benefits of a new racking technology.
What makes a company fit then from venture versus infra? I understand like on the infra side, you're looking for sort of performing assets. But I feel like there are companies out there who might say, well, maybe I'm a venture fit for them, but I've got project pipeline. Help us distinguish one layer lower for folks to sort of pick their venture with Align Capital.
Yeah, exactly. Turn to page 43 and decide what you're going to do. So yeah, I would say we can actually work with companies on both sides of our business. So we have done, investments in developers where we also are the initial buyer of the assets.
Yeah, so it's equity into the developer and offtake from the projects.
Right, exactly. It's basically just, the way to think of it is our infrastructure business will never take equity in a company. Our venture business will never own or take equity in an operating asset.
Yeah. Mm-hmm.
So, but we have both pools of capital. We have some ability to do credit as well. So,
are there battery only projects that you're interested in?
Yes, we have a few battery only projects in our most recent fund. Definitely think we're going to see more of that over the next, call it 5 years. So yeah, it can be storage, it can be solar.
Yep.
We've even started to see some distributed wind projects, which is really interesting. So, there's some states like Illinois, the new program that may be emerging in Ohio doesn't need to be solar. And in some of those Midwestern states, putting up a few wind turbines, you can actually get really good production and you're selling at the same rates as you would under a community solar program.
So I've had a lot of conversations recently with investors and folks who service IPPs and investors around the reality that not unlike our listeners who chose to listen to this episode and they're sacrificing this hour with us today, your team, same as NextEra's team and a big IPP's team, have no lack of content to consume from, right? Like inbound deals. And eventually you have to, well, not eventually, sooner than later, you have to filter for no, right? We need to get to no fast rather than yes. Mm-hmm. What was some of those early no's that defined clearly the lane for you, where you felt like, okay, we're really actually maturing into what we feel like is the asset class we want to lean into? Mm-hmm. What guardrails did that moment help create for the firm?
Yeah, I think on the venture side, we passed early on some pure technology bets that, very capable, experienced management teams, mm-hmm. but they were really just creating new technologies. And we had just gone through and seen how hard it was to commercialize the technology. And so we passed. I think that really defined us as not a technology investor, but sort of more of a energy transition investor in our venture business. And on the infrastructure side, we've kind of just grown with this market. I don't think we've ever, in some ways, we sort of, we're never going to compete with a Carlyle or an Ares or a BlackRock on utility scale projects. So we don't try. We try to stick to where we have the type of capital, the size of capital, the size team, and the expertise that works for our partners. And I think, again, you don't have to be everything to everybody.
Yeah.
And we don't try to be.
Well, how tempting it is, though, to drift towards those trendier deals. How, as a founder, do you and Peter build a culture around being disciplined in staying in your lane? Can you talk a bit about that sort of team building and that company building piece of the journey?
I think like any leadership, it starts from you. You have to be disciplined. You have to stick to what you actually say you're going to do, and your team picks up on that and that consistency. But we spend a lot of time internally talking about how we see the market, sharing our experience, because part of what we're trying to do with our team is download the experience that we've had to them without having to have gone through that, right? Because somebody who's entering this industry now, some of our younger associates, they don't know of a time when clean energy wasn't 90% of all new power generation, right?
Yeah, right.
And they've never gone through a distressed asset workout. And so I think that is what our team meetings are about. It's what our investment committees go through. We think about downside risk. We think about, and we try to share our perspective. And then we try to bring in as many people from the outside. We really encourage our team to go out, be part of the industry, meet other people, network, go to conferences. And I think just the more you learn and have knowledge and see different experiences, the better informed you are as an investor.
Brendan, you have a lot of folks in that vein who you got to filter out as quickly as possible. And in that regard, it'd be useful to be able to provide folks this sort of toolkit where they can better understand if there are 4 to 5 things that founders must fix or really get clear about before they can come talk to an investor like Aligned Climate Capital.
Yeah, I think maybe we think of this as the things to really have clear in your mind or ready when you begin a fundraise, and because it's going to save you time and it's going to, have more success. So I think first and foremost, which sounds obvious, is really know your business and know how to explain it to somebody that doesn't have any context on it. You have to be really clear about what the product is, who your customer is, and how you're servicing that market. So that's number one. Just we need to know what you do. Number two is really think about the size round you're trying to raise and make sure it's appropriate to your size company and the types of investors you think you're going to bring in. We've seen great companies fail in their fundraise because they went out for too large of a round size, and investors that were interested in the company just said, you know what, that's too big for us. And it turned out to not work in their favor. 3, have your data room ready, have your materials ready. One of the worst things is you have a really great first meeting, the investor follows up, and then it takes you 2 months to get them the materials.
Right, I'll get right back to you.
Yeah, exactly. Yeah. Oh, yeah. We're almost right there. From us, we start thinking, is that because you're disorganized? It's a bad management team. You don't actually know what you're doing.
It's like the dog caught the tire.
Yeah, exactly. So be ready to follow up on interest. Have your financials in there, have your materials, have a good deck, have it be very clear. You can always supplement materials with diligence questions, but have your core data room ready. I think 4th is, and this varies a little bit by company, but understand the different types of capital. Know who actually would be interested in a company like yours and in a stage investment like yours. So, if you're raising a Series C, don't go to BlackRock, right? And then 5th is, I think ahead about what you want your investors how you want them to be a part of your company.
Yeah.
Do you want just passive capital? Do you want somebody who is strategic, who can bring operating advice to you? Do you want somebody who, their other portfolio companies may be your customers? So really just understand and be able to communicate to an investor, this is why I think you would be a great investor for our company, because you can help us create value in the following way. And I think if you got those 5 things ready, you're going to be much more successful in your raise.
I feel like the data room piece, it does keep coming up. And it's funny because folks will say that they are interested in raising a round. And then to your point, investor says, okay, cool. We're ready for the next step. And it's like, I'll get right back to you. I'll send you the deck in 2 weeks or whatever. And it really should be 2 hours. Doesn't it feel like we're at a moment where AI is helping solve this problem? Are you seeing that on your side?
It's a great question. We probably don't see it, but I would imagine it's helping. And I think you should use those tools. But at the end of the day, a lot of what we're looking for is, and look, maybe there are AI tools that can help you do this, but we just need to validate your customer list. You came to us with a deck that says you've got the following contracts in place. We need to see those contracts. We're going to read them. I think honestly, just corporate financials, you would think that would be a pretty basic request, but it's often something that is not really well done before a raise is started. It's one of the things we tell our portfolio companies is your CFO is probably your most important hire, particularly as you get into later rounds. Your investors will demand a level of reporting and a level of financial management and reporting that needs to be professional and institutional.
The other piece that stands out for me in this list is understanding not just the size of the round, but one of the things I heard you say is what you're going to use the money for. Do we still see like an over exuberance of folks who perhaps are trying to get a 50 million raise off $1 million business, as though we are in a tech industry? Like, what would you say to those founders? Like, if we drilled down on this, like, how do you provide a sense of sanity and advisory to founders who are trying to think about the appropriate size for their company round?
The first thing I would say is if you're the founder or the CEO, your job first and foremost is fundraising, and it's never going to stop, right? And that's not a bad thing. That's what you're signing up for. So don't be scared of raising a round that you think is not sufficient to take you to your grand vision, because I think successful fundraising is going to lead to additional successful fundraising.
Yeah. Okay.
Your future investors will see traction with other investors. You will meet and engage with investors during that process that maybe they don't come into that round for whatever reason, but they come into the following round. So I think that's particularly in this market, always be out there, always be engaging capital. But be asking for an amount that makes sense, right? So if you're $1 million company, to your point, don't go out and say, "Hey, we're doing a $50 million Series A," because we want to hire 200 people and we see a ton of opportunity. That doesn't fly, at least in our experience, anymore. I think the other thing is don't be discouraged or confused by the headlines, right? You'll see headlines for massive rounds for companies, and you're like, "Oh, I wish I could, wish that was me." The details are always usually a little hidden behind some of that. Base power raising $1 billion, check into the details. And you don't need that to be successful. It also, we were talking about this before, your investors want you to raise the right amount of capital, right type of capital for the growth of your business. If you're only ever going to be a $250 million, this isn't a bad thing, $250 million or $300 million company, don't raise a $75 million round, because all of your existing investors are going to get wiped out.
Yeah.
And they're not going to like that. So really just be thoughtful, realize that I think the Series A, Series B, seed, we maybe get seduced into thinking that they're very discrete events. In our experience, companies, and particularly now, it's more, A1, A2, A3, B1, B2, B3.
I see a lot of that. Bridge rounds.
That's not necessarily a bad thing.
Yeah. First, second, third, fourth close.
Yep. Yeah, exactly.
Which of these 5 do you find founders routinely get wrong?
I think the one that I would expect them to get right more often, maybe to answer it that way, is to know your business. I think it is really, you have to be able to communicate the story and the purpose of your business clearly and quickly. And that's not because we're impatient or we want to get an elevator pitch. It's because we are looking at hundreds of companies all the time, and we need to understand it and understand if it fits us pretty quickly. And I think, for better or for worse, investors are generally in a screening phase all the time, right? You want to get to know more than you want to get to yes.
Are we still in a classic Silicon Valley elevator pitch? If you can't tell me what your business does in 30 seconds, I'm not interested. Is this?
I think for Aligned, we have a little bit longer than a TikTok attention span. At least I hope we do. But I think you need to do it in 2 minutes. And in your presentation, I think this is a common piece of feedback, is we don't need you to explain the market opportunity to us. We're an investor in this market. We get it. We need to understand why your business makes sense, what you've accomplished to actually prove out that concept, and why you have the right skill set to execute it and grow it.
Yeah, I find a lot of folks still lead with the TAM is enormous.
Exactly.
What's running through your head in a pitch, right? When a founder is starting there, but you've asked for this meeting because either they came from a credible resource or you believe they are fundamentally going in the right direction. What is it that you're looking for from them beyond the thing that you just enunciated, which is, do you understand the market opportunity? Is there something behind that you're really hoping for?
I think you need to, when you're having a pitch meeting, whether that is an investor, a customer, strategic partner, you need to be understanding who they are and what their perspective is. And if you're just coming in to Align Climate Capital and telling us about the TAM for renewable energy, you haven't really thought about who we are before you came in.
Yeah.
And that tells me something about how you would approach other meetings with key customers and things like that. So I think it's, again, this is just sort of something with working with management teams now for 20 years. In our experience, the ones that tend to be most successful are those that really understand their business, understand how to operate, and are very clear in what they're trying to accomplish. And they're not chasing a market opportunity, they're chasing a very specific business opportunity.
What I heard you say is investors, and I'm going to say aligned, but let's just layer that with clean energy investors in particular, want to see in your pitch how you treat them as though you were a customer, because you're asking them to buy something.
Yeah.
And therefore, your approach in the pitch is a litmus test for, can you sell this thing at all? Am I going to have to put resources behind you and coach you on how to sell this thing? Or can I just put some money to work and trust that you've got the right team in place? Like the pitch itself is more than a sort of a fundraising activity. It is a refinement of the sales pitch of the company to any customer. And it is a billboard for how well you might do at that once you've got my capital in your bank account too.
Yeah.
That's really interesting.
Yeah. I'm a musician. That's one of my hobbies. And I think musicians play with their personality, right? You hear somebody's personality through their music. I think the same is true with founders and pitches. You can learn a lot about somebody and how they will continue to operate as a leader of a company from how they interact with you in a fundraise. And you got to get comfortable with that if you're going to give them a few $1 million.
As a musician, how much of your perception of what's happening in the meeting is based on your sort of pre-conditioned expectations for performance, like vocal resonance, presence, all these things? Like, are you forgiving there, or do you find that you've got a really high bar in that regard?
Yeah. It's interesting. Look, I think at a certain point you need to be professional in your presentation, right? But I think over performance is probably a negative, right? Too salesy. Again, it's just, and it's like just like music, right? There's no right or wrong in terms of, it is your personality, right? So, we have founders and various, successful companies with different personalities of the founders, but it carries through, right? So we have one founder who is just incredibly knows his business, is very detail oriented. His customers love him because he has a product that is perfect and exactly what they need. But the man cannot talk. He is not a salesman, right? He's just not able to communicate that vision, and he has never talked about TAM like once in his life. But it's a very successful company that are doing great, and he has, to his credit, surrounded himself with other people on his team who balance out his weaknesses or what he's not as good at. We have other founders that are incredibly good at capital formation. They are very good at getting themselves in those rooms, selling the vision, and bring in other folks to really be their day-to-day operators. So again, it's, we really at Aligned, I think we look at the team. I would say if you look at our investment committee memos, we talk about the non-CEO or the non-founder more often in our team diligence. Is it a good CFO? Is their chief operating officer really effective? Are they going to be successful? We probably underwrite more to the second or third person in the C-suite than we do the CEO.
The other element that founders come in with a sense of either like exuberant overconfidence or like obvious sort of fear and trepidation around is valuations. They've come way down, and it's a thing where you have to put a flag in the sand, hopefully an educated hypothesis. How do you help founders recalibrate what's realistic in the current market?
We try to tell people what we're seeing in the market.
Yeah.
And I think at the end of the day, this is the beauty of markets, is price discovery happens.
Yeah.
If you have a better term sheet than ours, tell us. And we can adjust. We can tell you if we can match it or not. And I think that is maybe also kind of our infrastructure background.
Yeah.
That's a very common thing in infrastructure. We're pricing assets. We don't need to be embarrassed about, tell me where I stand within the bids.
Yep.
I think the other thing to tell the founders is, again, this is sort of appropriately sizing your round. raise $10 million at a $50 million valuation, grow the company for 12 to 18 months, and then get a higher valuation and raise some additional capital. Don't try to raise 30 to $40 million when you're really not going to be able to get a valuation that's not giving up a majority of the company.
Right.
I get it. Look, we fundraise at Aligned. I would love nothing more than to like be done and move on and run the company. But you just always have to be in the market.
Always
and
be
I
selling.
think you'll do better that way. Yeah.
What can you share about what you are seeing in the market? Where deals are working, where they're not? What can you share about what the deal structures look like right now?
Yeah, I think for venture, I think what we are seeing is certainly valuations are down compared to where they were a couple of years ago. I think everybody's aware of that. Deals are taking longer, even very good companies. It's taking 12 to 18 months to raise a round. There'll be multiple closings. I think, again, that is okay.
Yeah.
I think we're seeing a lot more rounds led by existing investors, so people within the company putting more capital in. I think that gives confidence to others to come in. And I think even very hot sectors, the sort of, grid management, sort of data center adjacent, advanced geothermal, advanced nuclear, I think valuations are still maybe not where some of the founders expect them to be at the end of the day. And that's, again, I think you just got to take what the market's got, continue to build your business. I'm probably speaking against my own interests here, but as a founder or a management team, continue to get options in the company as you do subsequent rounds and you build a company. Don't worry about what your diluted ownership is after a specific round. If you're doing a good job, your board will want to incentivize you. They will want to make sure you have enough ownership in the company to be motivated to keep going.
Yeah, just look at Elon.
Just look at Elon. Yeah. Hopefully you don't have to go to court to defend your package.
Or to the flip side, hopefully if you go to court, you can still come out ahead and flaunt it with $1 trillion package right behind it.
Exactly. And then, take SpaceX public. But so I think it's still some recalibration. I think some founders sort of feel like it's a failure if they don't get the valuation that they wanted. Once your company is profitable at a certain scale, capital will flow in that will reward you for what you did. Worry less about what your Series A. Any major exit, any successful exit, who knows what their Series A was? What people care about is how much, now that I have $1 billion company, how much of it do I own? And how much did I invest originally?
I'll counter that with, I'm regularly in a conversation where people talk about NextPower's Series A and the multiple return that those investors got.
Yep.
Even though, by the way, like what most people forget is that like everybody looks at NextPower now as like a $10 billion mid-cap company, and almost all of the investors, almost all of the founders got paid out in the acquisition long before they went public, right?
Yeah.
When Flex bought them. And so you can't you can't predict the life cycle of that capital in terms of like how it's going to I'm going to say like personally make you wealthy. Like Dan Sugar, for example, as the CEO of NextPower, has doubled or tripled his wealth since going public, even after making life-changing money selling it to Flex. So if you're doing a good job, investors are going to bet on you, and you have to give them a return on their capital for them to continue to bet on you. One of the things that seems to be moving as like an invisible arm in the marketplace, policy and irrational exuberance, is the electrification demand, driven largely by the data centers or the promise of data centers. Industrials, load growth is how we generally describe it. How's that showing up in the deals that you're seeing?
I think it is everywhere, right? It is probably the most dominant theme. It is a great time to own power plants. So, our infrastructure business is definitely benefiting from those tailwinds. We are seeing, whereas probably a couple of years ago, we'd see a lot of EV charging companies. We're seeing a lot of companies around grid management, load flexibility, demand response. I think people realizing, hey, we have a lot of power generation on the grid, but how do you line up and firm power? How do you make loads flexible? I think there's a lot of attention going there.
Okay. So I have a couple of questions to drill on. First, are new counterparties showing up to the table?
We really haven't seen many yet,
Okay.
at least in our space.
Okay.
I think if you have money related to AI, it's going into AI companies right now. I think AI continues to suck capital out of every other part of the market. um, but I think what is interesting, and I think we'll probably maybe start to see this in another year or two, is these companies that have committed to large data center. I mean, a lot of the tech companies obviously already are major investors and off takers for renewables. But I think we will, same way that, I remember the first time I was like, oh, why is Google investing in this space? Or, why is Amazon investing in this space? I think we will see some of the AI companies as well, as we already are starting to see, but they will, I think realize that maybe SMRs are not their immediate future, and need to take some bets in some more near term technologies.
Speaking of, you said it's a good time to own power plants. I want to understand that because my hypothesis is that your power plants have contracted power. Why is now a good? How does that give you flexibility?
Yeah, a lot of our projects, they are community solar projects, and so they are indexed to the regulated rate. So as rates rise in PJM and it's generally energy supply, but also transmission, in some cases distribution as well. We rise with those boats. So I think it's also for us with energy storage, particularly kind of in the distributed energy storage market. Absent a really strong state program a couple of years ago, it was harder to make those projects economic. Now the grid services, the energy arbitrage, some of those ancillary services are much more valuable, and we have more confidence in those markets being valuable. So that makes those projects pencil more for us.
So we talked about what makes something fundable, right? Like how do folks trying to raise money want to approach you and folks like you? I want to shift to once you've got that capital, what breaks? And what disciplines separate the durable platforms like the Summit Ridge from the fragile ones, nameless, but non-existent now at the end of 25 that we all were scratching our heads about in the beginning of 25. After a platform raises serious capital, and we've seen a number in the last 12 months, where do you most often see things start to get in a tailspin, start to break down?
I think the classic one is you raise a round, you hire a ton of people, the revenue projections don't scale as quickly as you had anticipated, or things get delayed, whatever it is, and your burn is way over your skis. And good management teams will see that coming, and they will reduce headcount. And I think it's the hardest part of being, an early stage company management team is you got to be really disciplined in terms of both your hiring and your willingness to reduce the number of people working there. You got to lay people off sometimes. And it sucks. But because the challenge is once you have embedded operating costs, it's hard to shed those quickly.
Are you jumping in at a board call like on a quarterly or monthly basis and saying, hey guys, have you thought about laying people off? Right?
If the case warrants it. I mean, I think we are strong proponents of, and in some cases, maybe it's not laying people off. Maybe it's saying, look, let's slow down on the hiring plan.
Yeah.
It needs to grow in equal proportion to the growth in profitability and revenue.
What's a system that you wish every growth stage team you invest in would put in place earlier?
Strong financial reporting.
Say more.
Really good quarterly reporting to your investors. 3-statement reporting, reconciling that to actuals versus forecast. So being able to get your investors your financial data and information as quickly as possible once a quarter ends, because that's, as we are, if we're members on the board, that is what we need to see in order to manage the company.
Yeah.
And be there as the fiduciary for our investors.
Is that a system and a human capital issue, or is it like where does the breakdown in financial reporting tend to happen?
It's a combination of things, and this is an instance where I think AI will really start to help a lot.
Yeah.
But yeah, get off QuickBooks as soon as you can, right?
Wow. In exchange for?
There's a lot of enterprise software tools out there, but you need a more sophisticated accounting system ultimately. And it's building in those systems into your team financial controls that you're getting timely feedback from the different teams about what they're spending and what they're not. So you're not recasting or adjusting your quarterly financials multiple times.
What I hear you saying is like you need more visibility, nuance into project-based accounting.
Project, team-based, business units, however your business is structured.
What are examples of tools that you often have to recommend to your portfolio companies instead of QuickBooks or instead of something else that they were previously using?
I probably shouldn't recommend specific specific products, but I mean it is. I mean even Intuit, which has QuickBooks, has an enterprise software tool that is just much more effective, more dynamic. There are a bunch of tools that can also bring in invoices. I think that's also sometimes where companies get overwhelmed, is as the businesses get more complicated, they have more customers. It's not just sort of your P&L and your, kind of your accounts payable. It's also understanding where are your cost centers and where is your spend being allocated.
Yeah.
And that can sometimes be harder for earlier stage companies if they don't have the accounting systems in place to track that.
Well, now I would assume that there's a couple of logical placements that will come in the next question here. But when you think about team design, as a result, you're deploying capital. Maybe you've been impressed with the founding team. You're pretty clear they're going to expand quickly. They're probably, because of kind of the kind of investor you are, they're going to be asking you for advice as well as capital. What roles do you see as non-negotiable for deploying hundreds of millions of dollars responsibly?
If you're a company that needs that level of capital, you got to have somebody on your team that has worked in capital markets before. You need somebody that knows how to present I mean, it's one thing to present financials to us on the board. It's another thing to present it to Carlyle or TPG or KKR, or pick your large financial institution. They're going to expect a level of reporting and disclosure that you're probably not used to as a company that's taken venture capital and has a banking relationship.
Yeah.
So you need somebody that understands what they're going to want, whether that's your CFO, whether it's a head of capital markets, head of project finance, whatever. But again, that's usually non-dilutive capital. And if you know how to access it, that's a great way to build a business.
Where do you feel like founders perhaps will stay within the portfolio that you've managed, unless you feel like you have an answer that's more general? Where do founders underinvest in talent as they're scaling up?
It's hard to say there's a constant, because I think it partly depends on the founder. Sometimes founders, I think, over-index on, they came from a larger company, so they're saying, "Hey, I need to have a head of people," and I'm a Series A company. It's like, maybe that's not the best hire, and you're under-investing in business development and finance and other things like that. I think, look, for us at the end of the day, particularly an earlier stage company, you want to be investing in people that are generating revenue and people that are helping raise capital. And that is, your whoever, business development, origination. If you're a technology company, obviously you need to continue to invest in your product and your technology. But I think you can over-index on software engineers, research team, because you want to build the perfect product right from the start. And I think just understanding it's going to be iterative, and you got to build the company over time.
Is there any particular capital structure that you see? I feel like maybe 10 or 15 years ago, when all of Silicon Valley were writing their playbooks on how Silicon Valley works, right?
Mm-hmm.
All the tech stars, founders were like, "This is how to raise money." There was a lot of hubris around, "This is the kind of structure you want," and everybody was following Y Combinator. Is there a structure that you think is in the market right now that looks clever but really becomes painful?
I don't know if it's a bad structure, but I think people have raised a lot of rounds previously with a safe or maybe a convertible note because they didn't want to have to deal with valuation.
Yeah.
And now they've got a few rounds of safes that are sitting out there, and that makes a priced round even more challenging to get done. So I think it's hard to sort of say there's a universal, but there are times you want to actually have price the company, take in investors, have them feel like they actually have securities in your company, establish a board. Don't be afraid of that. Don't worry if when you have to tell people what your valuation is that you don't like it. If you continue to build a good company, it'll go up.
Man, I mean, one of the through lines I hear in this interview is be humble or you'll be humbled.
Yeah,
Yeah. Like
especially in this market.
hubris in this market is the antidote to clever and successful fundraising.
Yeah,
Unless you
you start
actually,
start an AI company.
yeah, exactly.
I think
Unless
if
you,
your approach to the world is hubris and like just sort of bullshitting your way through, it's like go start an AI company and
there's
move to San
always a
Francisco.
market for it. Honestly,
There's always a market.
there's
That is
always
totally
some
true.
market. You got to figure it
Yes.
out. Like this year, it's AI. Oh,
Yes,
that's true.
exactly. Yeah.
Um, and on that note, what's a contrarian view that you hold about the transition that maybe many of your peers might disagree with you on?
It probably depends on what room you're in, whether it's contrarian or not, right?
Yeah, of course.
But I think we have to have an eye to this being affordable for people, right? I don't think we can have an expectation that we can just ram change through. Change is hard. Societies change very slowly, and you need to make it exciting and cost effective for people. And I think if we look at where our industry succeeded, and this took a ton of policy support and it took advocacy, and we wouldn't have gotten here at all without that. But to be at scale, you need to get people. You need to. Why do they want to switch? Right? It's a better experience. It's cheaper. Whatever. Maybe another contrarian view is, I think the best thing the U.S. can do for climate is drop all of our tariffs to China. Let us flood the market with Chinese EVs and modules for 3 or 4 years, and then figure out where we go from there.
And if you don't think that's true, then watch Mexico over the next 5 years.
Watch the rest of the world.
This experiment is happening with or without us. And I would say, like, I was just in Mexico, BYD electric cars everywhere, selling at the low side for $13,000.
Yep.
Right? It is inevitable. I often use that analogy from The Matrix, where like the guy picks up Neo's head, he's in the subway, and he says, "That is the sound of inevitability."
Yeah.
Yeah, you don't have to go very far outside of our borders, but you do have to go outside of our borders or subscribe to, God forbid, Al Jazeera, and you'll see that the rest of the world is moving right along with this transition.
Yeah, that's what I tell a lot of people. Next time you leave the United States, rent a BYD.
Yeah,
when you rent a car.
Yeah, and enjoy it.
It's a great car, and it's really cheap.
Totally.
And if you live in a country other than the United States, you're going to buy one in the next 5 years.
It's true.
And it's just because it's cheaper and it's a better car. And so I think that's the other thing that we've been experiencing a lot is the way that Americans, both those that are in favor of climate action and clean energy solutions and those that are not, it's normal. We have a very American view of the world.
Yeah.
In this market, the rest of the world is much more optimistic and changing much faster than we are.
Yeah. Look no further than COP30.
Yeah.
Yeah.
And it's not just China, it's not just India. It is Latin America, it is Africa, it is Europe, it is the rest of Asia.
I feel like I need to do. Go ahead.
Yeah.
Keep going.
Yeah, you should do like Nico travels the world, right?
That'd be fun, actually. Like,
it'd be cool.
Like, show people how Jesus. That's a great idea, Brendan. Just how enthusiastic. So we're on the precipice of, and possibly by the time this episode launches, we will have announced that we're going to be doing more stuff back in Latin America.
Yeah.
The unbridled enthusiasm in Latin America for electric cars, it's amazing. Yeah. They're everywhere.
Everywhere.
I remember, like, I have a friend who bought the first Tesla in Puerto Rico, right? And for now, we're going to call Puerto Rico Latin America, even though it's American principalities or territory. And I've watched how, because of the work I've done in Latin America, how each of the islands and Central America and Colombia and Chile and Brazil and Argentina have begun to adopt and then embrace renewable energy and electric vehicles in a way that, like, is very Californian. Yeah. I'm very enthusiastic about what the rest of the world is doing.
But you take the politics out of it, particularly the American politics. You take the need for climate action out of it.
Yeah.
And you sit there and people are like, it's a car that is frankly better to drive.
Right.
I can charge it in multiple places.
Yeah.
And it's not more expensive than the alternative.
Yeah.
Like, I mean, if you just look at what this is bringing you, clean energy is able to be deployed more places. It's cheaper. Electric vehicles are cheaper. They're better to drive. It's just, this is like, people are excited because it's a better way of life. It's like getting clean water.
Yeah.
right? It's like if you've never had clean water before, you don't care if the well is there to like,
Yeah.
whatever. You're happy you have clean water.
Yeah. And by the way, people who say, oh, but they don't have energy economies. Bullshit. Colombia, Brazil, Mexico, they're petrostates.
They're petrostates. Look at Saudi Arabia.
Yeah.
Saudi Arabia is not using oil for power generation.
No, they're not.
Well,
I've only got a little bit of time left with you. I want to dig in a little bit into sort of philosophy and your observations, having invested in some of the brightest minds, in my view, in the industry. Without going into your portfolio, I'm extremely impressed with the folks that you've backed and the work they're doing, in particular around like proving that hybrid systems and that renewables and PV and storage can service baseload. So you've watched a generation of founders and developers kind of come through this space. What separates the ones that you see building enduring platforms?
I'm not sure there's one through line, but I think it is first and foremost knowing what you know and knowing what you don't know.
Mm-hmm.
The Elons are much rarer than other founders in our portfolio that really saw a business opportunity. They had experience in it, and they built a great company.
Yeah.
Versus I see this vision of the world that's different, and I'm gonna build the future, which is incredibly powerful, but that's hard, and often fails. So I would say the most common trait of a successful founder or management team of ours is they really know what they do. They're not trying to be everything to everybody, and they know how to build a profitable business, and they are doing that from day one.
And they have a beginner mindset. They're unafraid to start over. I mean, the interview I did with Martin at Bright Night, like, wow, how far ahead he was investing in AI.
Yep.
And believing in the thesis and basically starting over and saying, well, 8 Minute didn't get there, so I'm going to start over and do it again.
Yeah.
Summit Ridge in many ways is in sort of phase 2 of that. We got to get
Steve Rader from Summit Ridge.
We got to get Steve on here, by the way.
SunEdison bankruptcy.
Yeah, that's right.
He started Summit Ridge after watching his bonus go away, his equity go away in SunEdison.
Yeah.
He said, I don't want to do that anymore. I want to start my own thing.
We have a whole generation of folks like that, right? Forefront, Dimension. Like the list is long, right?
Yeah.
And I would say arguably Steve and Summit Ridge stand at the top or very near the top of that list in terms of quality assets. So if you stripped away the fund size, headlines, and assets under management, what would you say your actual job is as a capital allocator right now in this market?
I think, at the end of the day, it's understanding risk and making the best decisions we can for our investors. But I think the thing that we at least talk to our team a lot about is making the investment is the easy part. Managing it is the hard part. And so you really have to be ready to be in the venture space, on a 10-year journey with these companies, understanding what you can do to help them, what you can't do, and what's not your role. And then, on our infrastructure business, something will always go wrong, right? So, we can build in as much as we can in terms of downside protection, but when something goes wrong, you understand how to fix it. You understand how to move forward. You how to manage, the risks associated with it. Because if you expect it, I mean, it's sort of interesting, right? We're in a time where everything seems to be, nothing is easy.
Yeah.
And I think it's a Jamie Dimon quote or something like that, or one of the major banks. He's like, this was a couple years ago. He's like, I've worked with people for 20 years that I have no idea if they're a good investor or not, because they've never invested through a down cycle. It's always been low interest rates and a boom economy. And I think that's what we're finding out now in the clean energy climate space, is who's a good investor and who is just kind of riding a wave.
Right. I want to do if you'll bear with me for 3 to 4 more minutes. I know that we're at the end of our time. A few sort of rapid fire questions to wrap up.
Okay.
What's a founder habit that you wish more people generally would adopt?
Founders have to not give up, because everything goes wrong. And it takes a unique personality to be able to take rejection, to take failure, to take all those things and still move forward.
What's the most overrated metric founders put in their pitch decks?
Who their existing investors are. I don't care if Sam Altman's your investor.
That's awesome. What's a subsector that you think is quietly mispriced right now?
I think electric vehicles in the U.S.
Yeah. Okay. What's one signal of a strong management team that you feel is hard to spot?
I think it is doing what you say you're going to do. When we talk to somebody and 2 months later they come back and say, those things that we talked to you about, we actually did them.
Yeah.
It's execution.
What's the corollary? What's the signal of a strong management team that almost anyone can spot?
I think experience. Experience does matter. Their resume.
And experience speaks for itself. Is there a book or a framework or a mental model that you found you routinely return to?
You got to take a break. Can't do this all the time. You got to have other parts of your life.
Where does that show up for you? How does that show up?
Play music.
Yeah?
I have my family play music. I play traditional Irish music, which is about the opposite of running an investment firm.
What instrument?
Nice. I play the flute.
You do? Flute. You play flute in Irish jigs.
Yes, exactly. Reels and jigs.
I genuinely can't imagine you doing this, so I'm gonna have to. I gotta see this.
Come to LA. Yeah, a couple times a month. There's a session. So
can't wait.
There you
go. I will take you up on that.
Nico, I actually don't know this. Where do you live?
I live in Durham, North Carolina.
You're in Durham. Okay.
Yeah.
All right.
That's fascinating. Hey, Brendan, as we wrap, one quick question to close this out. What will have changed as a result of the work that you're doing?
I think we're going to build a healthier, more livable planet for my kids and other people's families. I think that's what this is all about. It's how do you create prosperity? How do you create people's jobs? How do you power people's homes? That's what I love about energy. It touches everything, right? It touches the environment. It touches national security. It touches quality of life. That's what we're here for. Can we build things better, cleaner, healthier?
Brendan Bell's Chief Operating Officer and co-founder of Aligned Climate Capital. If you are in the market to grow something that touches venture or looks like infrastructure, you should reach out. We'll put all of the contact details for Brendan and his company in the show notes, and we'll certainly be promoting it on LinkedIn. Brendan, thank you for taking time to join us here on SunCast.
Thanks so much. It was great.